Draghi will be talking this week about his quantitative easing program, okay? That's demand push inflation. It's a big deal. Roll the intro. Traders, what's going on, guys? It's Cleveland here with another high impact. Hope you guys are having a good Monday. Markets haven't moved so much. We did have CAD rip a little bit. It's back inside of that consolidation. I'll show you guys a screenshot, but we were hoping for a little bit of US weakness. Okay, it's a little bit of the contrary story to what I've been, spilling out there for the past couple of weeks. But we had some bad inflation numbers come out last week. We had a CPI reading come out last week for the US. Expectations were really high, in my opinion. We're looking for, I think, a 0.6 increase, and we only got 0.5. So we missed target. Okay, we missed target. But core inflation, all right, it still hasn't moved yet. It's at that 1.8, 1.9% right now, okay? And inflation is a story all over in all the central banks, okay? So that's what we're going to be talking about. There are 2% inflationary targets in Japan and in the ECB, in Canada, in the US, and in, again, some of the more larger advanced economies there, and they're all missing target, okay? ECB is one of them, all right? So that's what we're going to be discussing here. If you guys have not seen last week's High Impact, we talk about NFP a bit, and we give the results on NFP. And again, we just pushed out the Monday breakdown, and both of those will be below. And guys, this information, it comes out real quick, okay? So I want to make sure you guys are subscribed, so as soon as I throw these things out there, you're able to learn and then react, all right? And while you're there, just might as well like the video, all right, for your boy, okay? Appreciate it. And outside of Draghi speaking about quantitative easing on Wednesday, we have some other releases coming out this week that are going to be really important for you guys to pay attention to, right? So we have CAD, the NZD, and the GBP. They all have CPI releases coming out, and they're all looking for that 2% inflationary target. No one's really hit it yet, okay? No one's hit it yet, and it's going to be important for you to rationalize where they are in the spectrum of consumer prices and consumer spending. It's one of the most major discussed topics right now in the capital markets. So anything aligning in that capacity fundamentally, you guys are going to want to make sure you pay attention to it, okay? So currently right now, Draghi and his ECB, they've been doing QE, and they've been doing QE since 2009, all right? And since 2009, they've accumulated over $4.5 trillion debt, okay? So again, you guys are going to want to go back and watch some of the videos on inflation, because I'm not going to elaborate here because I already did that previously. In that older CPI video, we discussed two types of inflation. We discussed demand push inflation and cost push inflation, right? So cost push inflation is when consumers are spending more money in the economy. There isn't any more money being printed, and the money that is in the economy is being used more rampantly, right? So it's not just sitting inside some savings account. But then there's also demand push inflation, where you're just literally throwing money into the economy. You hope that the money you're printing is being used, right? Hoping that it's going back into the economy, and that those consumers are actually doing things with it, right? Banks are being able to lend it out. Those people that are getting lent that money are able to produce more things, and blah, blah, blah. So you're going to get an uptick in inflation, right? And inflation is just, again, money circulating around the money supply, okay? So right now they're doing $60 billion in asset purchases month after month. All right, and what assets they are purchasing are government bonds, okay? So they're taking these government bonds, and they're literally just pushing buttons inside of a computer. So there actually isn't any real euros being printed. They're going to a computer somewhere at the central bank's office, I don't know where, and you have Draghi signing off on, hey, yes, it's cool for you to input $60 billion in cash to be created so that we can take that $60 billion and throw it into government securities. All right, and the important part about that is you guys gotta understand that that's the fixed income market, all right? So I might be talking a lot over your head here. I'll throw some descriptions and the definitions down below as I elaborate, but that's the fixed income market, and that's just another capital market in a sense, right? So you have what we trade, Forex, you have stocks, you have the fixed income market, you got all these other different ancillary markets that, again, they all somewhat align within each other. And as capital flows through each market, you may have some individuals looking at the fixed income market and saying, wow, there's a good return over here. You may have some individuals saying, okay, yo, the best returns right now are over in the capital markets, in the equity markets, right? So Apple, Yahoo, blah, blah, blah. And then you may have some individuals looking at the FX market, for instance, and say, hey, we need to play over into the commodities market, gold, silver, all those different things, depending on where they see the best return. Well, when they buy those assets, those $60 billion of bonds month after month, what's happening? Well, they're putting that over into the fixed income market, usually the safest market to play, all right? And when you put capital inside the fixed income market, what you're doing is you're actually going to be lowering the return, all right? So the more money that is inside the fixed income market, you're going to have an inverse relationship. The higher the bond prices are going to go, and the lower the yields are going to go. All right, so when you have an increase in yields, you're going to have a lowering of the actual cost of the bond itself. All right, and that's just because, again, if no one wants to buy the bond, then guess what? The return you're going to get on the bond is more. All right, and the government are going to be using those bonds to hopefully do things within the economy. They may do things like infrastructure spending. They may do things in the defense, right? So they may start buying more missiles and shit like that. That's where they're going to be using that money, and then hopefully they're going to be paying you interest on that money, right? So usually there is a clause in these bonds that say, hey, you're going to get your money back. So currently right now, that's what they're doing within the ECB. All right, he's doing $60 billion in bond purchases month after month. And they want to lower that. Okay, they want to take it to 50, 40, 30. I mean, this is what they're going to be discussing this week. And it's going to be really important for us to rationalize that because, again, think about it, folks. If they're not adding any more money to the money supply, all right, then guess what's going to happen? You're going to have the value of the money that is in the economy be worth more because people are going to rationalize that, hey, there's going to be less infusion of capital coming in to this economy right now. So the money that we do have is going to appreciate in value. All right. And so one more thing that I want to mention is when they are buying those maturities, again, about 2 weeks ago, we mentioned how the mortgage-backed securities market and how the U.S. were buying maturities as well during our financial market collapse. Well, those bonds are maturing. And as those bonds are maturing, you're going to have the budget, the balance sheet, the ECB balance sheet, they're doing the same thing. You're going to have it decrease. Okay. So right now they're dealing with two situations. There's a $15 billion maturity that's happening month after month on their balance sheet. And they're also buying more bonds. So the bonds that they bought 5 or 6 years ago are starting to mature. So the question is, are they going to allow those bonds to mature and still add and still have a monthly stimulus come in? Or are they going to rebuy those maturing bonds and have the monthly stimulus come in? Because if they do that, they're going to have a net stimulus and a gross stimulus. If those bonds are maturing and that $15 billion is eroding and they're doing a $50 billion stimulus month after month, then technically their gross stimulus in that given month was $35 million. You guys get what I'm saying? But if they don't have those bonds maturing and they're adding to the balance sheet via stimulus at maybe, let's say, $50 billion, then that means they're going to have a net $65 billion stimulus coming into the economy. Again, because they're not letting those bonds mature. Bonds will mature. If you bought a 10-year bond right now, you would be receiving semi-annual payments until those 10 years are up, and then you would receive your principal. Well, same thing for the government, right? Same thing for the ECB. They're buying billions and billions of dollars of bonds, but they did that 5 years ago. And some of those bonds come in form of a 5-year bond. Okay, and so since 2009, 2017, you can imagine that some of those bonds have been maturing. Well, lately they have just been reinvesting those maturing bonds back into the balance sheet. All right, so now we're going to see if they're going to just let those bonds mature and also have a stimulus, or if they're not going to let those bonds mature and just keep adding to the balance sheet. Okay, it's going to be really important for us to rationalize that, right? So that's demand push inflation. There's a couple other fundamental announcements that I want to talk about with you guys that are going to be coming out this week, though. And outside of what Draghi's going to be talking about this week, there's still some really important data releases that are going to be coming out, right? So we have the CPIs coming out for the pound, the CAD, and the NZD. We have some other things coming out like building permits for the U.S. Australia is also going to be having a employment number coming out. I think that's on Thursday. But you know, you guys need to understand counterparty risk. So that's the subject matter that I wanted to speak on a little bit because, yeah, maybe Draghi's very hawkish, right? And let's say you want to play the Euro GBP long because you see that Draghi is going to be fairly hawkish towards the stimulus program, right? So there's a 6-month, 9-month, and 12-month plus window that he may be stopping the stimulus. And if we can rationalize maybe, okay, wow, Draghi's going to be stopping the stimulus sometime in the middle of 2018, then you're going to be fairly bullish on buying that Euro U, which means you're going to have a really nice up move on that Euro GBP. But if you get some good news coming out for GBP, maybe CPI really exceeds expectations this week, then I want you to rationalize how that would stifle your Euro GBP up move. Okay, so you want to understand counterparty risk. If I'm trading a certain currency and I'm looking for a certain move within that currency based off of some fundamental announcement, then, well, what else is happening this week with that counterparty pair? Okay, a good example was the GBP JPY. We were looking at this massive extension outside of the GBP JPY because you had some good news coming out with the GBP. I think there was that shock election event, and you had risk coming off the table for the JPY. People were calming, what was going to be happening with North Korea, so a lot of money went back out side of the Japanese currency, which threw the GBP JPY to the up move. Okay, so when you have a currency pair, when you have a parabolic move like that, it's usually because you have one instance where there's really good news coming out for one pair, and then you have another instance where for that counterparty pair, maybe some bad news is coming out, and that gives you those amazing moves. All right, so for the Euro GBP this week, keep an eye on that. Right now, we're sitting right back down into the middle of some extension that happened last week. Maybe we'll get another run higher if he's fairly hawkish, and if the CPI comes out bad for the pound. All right, and so just rationalize that and pair those together, with whatever pair you're playing with this week. Okay, so guys, that's pretty much it. I'm glad you now understand demand push inflation. Let's see what Draghi says this Wednesday. I'm going to be really excited. We'll be over in the top trader community. Make sure you guys get into the rookie course if you want to learn the fundamentals of trading and work with us here. And other than that, folks, like and subscribe. I'll talk to you guys real soon. Peace.